Good evening, everybody. Welcome back to my channel. Yes, I thought I was done, but I'm going to make a couple more videos. And so normally I give you guys an introduction about, hey, my channel is about investing, e-commerce, teaching people how to make money in the stock market. But this is going to be a heavy duty video about stocks versus REITs versus BDCs. Which ones should you invest in? Should you invest in stocks or REITs or BDCs or a combination of all three? So make sure you strap in, like and subscribe to my channel. This video topic came from one of my subscribers. Shout out to Destiny. She wrote underneath one of my videos and asked, since she's a new investor, uh, she wanted to know about REITs and she wanted to know about stocks and which ones was better and whatnot. And I'm going to dive in. So for more advanced experienced investors, you guys already know what it is about investing and uh, REITs and stocks. And for the new investors, strap on in. Let's talk about it. So I have this quick article that we could talk about, and I got a couple two stocks just to give you guys as an example. So it says real estate versus stocks. Is there a winner? So when you think about real estate, you think about scarcity, limited supply, high demand, tenant prices, appreciates in value. I own my house, so you have a particular property, whether it's residential or commercial, and you make money through the you make money through real estate by collecting either buying houses, condos, townhouses, and charging people rent, or you can go down the commercial route. Then now you also have stocks. Stocks, rather you go down two different routes. You can go down the growth route where you buy growth stocks, or you can go around the dividend growth stocks where it's the same but it pays a dividend. So everyone have different strategies, and then even within the dividend growth method, you can go the high yield route by buying just high yield stocks or low yield stocks or a combination of both. So uh, with investing into real estate and also investing into stocks, there are many different ways and strategies that you can go about it. And so right here, so what is a REIT? So let's just summarize it. Not going to bore you. A REIT is a company that makes money by rent out, operate, or finance real estate holdings that generate income. Translation: it's a way for the common man, individuals like us, to be able to have exposure in the real estate market without physically holding and buying the actual physical products or the physical properties, but you still have ownership of said property. So, uh, REITs like VC properties, realty income, AMT, which is over like the towers. And so, what are the different type of REITs? There are equity REITs, mortgage REITs. There's a hybrid of both. So when you think of REITs, think of being able to have exposure into the real estate market, and you as a person have ownership of that, and so you get a piece of the pie. Simple. REITs. Stocks. When you think about stocks, you think of basically different businesses having ownership of said business, and you buying a piece of the pie. So, for example, as we all know, Apple, Microsoft, ExxonMobil, Procter and Gamble, Home Depot. And so to be like a said owner or investor, you go on the stock market like Fidelity or eToro or uh, Charles Schwab or E-Trade. So you go in, you create a profile, you put deposit your money in, and then basically you buy said stocks, the Home Depots of the world and the Apples of the world and the McDonald's of the world, and then you become a partial owner because you own those shares of stocks. Now, compared to REITs, if you buy O Realty Income or AMT or uh, VC property, you still it's like ownership like stocks, but you have ownership of these real estate properties. Simple, right? And so let's talk about how they're similar. Basically, both asset classes are sold and traded in form of shares on the major exchanges. Simple. Purchasing either of them meaning owning a small slice of the company ownership. So I just said that. So buying shares of Apple stock, you owning ownership of having like a small ownership of said Apple, McDonald's, Apple. Same thing with REITs. So depending on which REIT do you buy, you're buying ownership of that particular REIT, which in essence give you ultimately uh, access and ownership and just a piece of pie in the real estate market. So now let's talk about how REITs and stocks are different. Shout out to Destiny, this is for you. So my research, one of the major differences between REITs and stocks is the returns. And so from right here, from my knowledge, typically when you think of the S&P 500, the Standard and Poor, uh, when people say invest into the index, right here, you see right here from 1972 to 2021, the S&P 500 produced a annual return of 10.7%, which is nice. But right here, if a person was to had their money and invest into REITs, VC properties, realty income, AMT, uh, those are the major REITs I can think of in mind. They had on average produced 11.9. And so even for the past 25 years, past 20 years, as you see, REITs produced higher returns than stocks. So it's like, so why? I was curious too when I was doing this video for you guys. I was wondering like why, because I'm heavily 100% in stocks, right? And so it states right here that it says although there's a noticeable discrepancy between the performance in the last 10 years, it's apparent that REITs fare better in the long term. Uh, and so it says also dividends are one of the main selling points of REITs and have a historical driven around 50%. So the reason why REITs tend to on average, the reason why if you look at the chart right here, that the reason why REITs past 25 years, 20 years, 10 years, the reason why it has done quite better than the S&P 500 is because think of just the stock market in a whole in entirety. So when you look at the chart, it goes jagged. So like last year it was down, this year it's up, right? And so the times, the periods of when the stock market is down, you imagine that the S&P 500 dividend yield is around 1.5, 1.7% on an annual basis. But REITs tend to be about 4%, 5%, 6%. So even in high markets or bull market, you're receiving those high dividends. But then when the market is down, you're also receiving those high dividends. But those high dividends, if the stock or the REIT price, if it was once selling at let's say $40 a share, and like right now, if it goes down to $20, if the particular REIT policy of what their dividend didn't change, so you're reaping the benefits of buying more shares at that lower price. So the dividends right here says dividends are the main selling point of REITs that have historically driven up 50% of REITs historic returns according to their REIT. I just said that. So when the stock market is up, you're getting paid your dividend from the REIT, which is a higher 5%, 6%. But then when the market is down, you're still getting paid that 5.5%, 6%, and you're reaping the benefits of those high dividends, consistency, and buying it at a lower price, right? And then also volatility. We all know that in hierarchy, chronological, it goes crypto of super volatile, then stocks, growth stocks or whatnot. Then you have dividend growth stocks like Home Depot, uh, Lowe's, and those type of stocks where it may dip a little bit because of the dividend. It helps with the total return. And then you have real estate. Now, yes, the appreciation of houses and properties does go up, but typically it goes up slowly. But it will go up, but it goes up slowly compared to the annual rates of a particular stock. So, um, so by investing to REITs, investing to real estate, you also can bet on just uh, not so rocky, incline going forward. Now, like right now in 2023, the REIT space is down by a lot, and this is the perfect time to buy REITs. But hey, you didn't hear it from me. But typically, when you buy REITs, it you get more bang for your buck as it goes up, you'll be able to ride the wave less rocky. And so here are examples of REITs. So I told you guys about American Tower, AMT, Realty Income O, but then there's like a WP Carey, what's another one? Like Crown Castle, and then also Public Storage. So right here, so what can you expect when you invest in REITs? So basically, pretty much hands off exposure into the real estate sector, and then moving forward right here. Here is an example of a REIT that I like. So it's called Realty Income. So it's a dividend aristocrat. It invests into over like 100 properties, and it's in the United States, and it's also in Eastern Europe as well, and it's beginning to expand out. And so this is a great example of a REIT that has been, basically uh, just have basically stood the test of time right here. Yeah, it has gone up and down. It has it's tried and true, but right here, look right here, the dividends. So even just going back from 2018. So right here, you see right here, you see how the dividend is going up. Consistency, it's consistent dividend growth, consistency, and then now, right here, I explain between stocks versus REITs. Now, uh, REITs versus BDCs. What is a BDC? A BDC is right here. It's a business development company. I'm not going to go through all of this. Just wanted to understand that. Also, just as REITs have produced higher returns than stocks, BDCs have beat REITs, which is crazy, right? So right here, as you see right here, just want to show total return since 2015. Here's a group list of total returns of BDCs, and right here, boom, you see right here, green, green, green. So in a total since 2015, 103% for REITs. Right here since 2015, you see right here, it's a lot of mediocre numbers. And so why? So not to sort of see right here, a lot of the green of the BDCs, and give you an example of BDCs is you know, like Owl Rock Capital. I got that in my uh, dividend portfolio. You have Maine. You have also ARCC, and so the REIT. So then also you see the REIT. So the REITs that we just saw: AMT, ADC, O Realty Income. You see right here, total returns since 2019. It's not, it's okay, but it's not beating BDCs. So that right here, why do REITs underperform BDCs? Now, stocks underperform REITs. Now, but why do REITs underperform BDCs? Here's key, is that it should be known that most BDCs continue to position their portfolio away from cyclical sectors and into growth, like technology, defensive sectors, and then also with that, BDCs have a way higher interest rate than REITs. So just like REITs tend to come for a fashion of around 4.5, 5, 6%. A lot of the BDCs come, like ARCC, come 10%, 9%. And so if that company is able to maintain their dividend, and imagine in times like right now where it's a recession, yeah, the stock price may go down, but if the company still stay true to paying that dividend, buy the stock is getting low, you're able to buy more shares, just like with the REITs. But compared to the REITs, 5% compared to 10%, it's a no brainer, right? BDCs are fundamentally strong companies, upper middle market focus, acute risk management, attractive industries, high selective, and benefits of scale. And so, right here, give you examples of several REITs and BDCs. And so, the takeaway is here. The takeaway is this. And then also, I wanted to right here to let you show you guys an example of a BDC, which is right here, ARCC. It's $19.50. So here's the takeaway, because I don't want this video to be too long. Here's the takeaways. The takeaways is, so should you invest into stocks, REITs, or BDCs? I would say the way I'm doing it, because listen, I'm not a financial advisor, but the way I'm doing is that I'm investing to all three in my dividend portfolio. I have growth stocks. I have dividend growth stocks like Apple and Microsoft. I have REITs like Realty Income and AMT, and then I also have uh, BDCs like ARCC, Maine, and Owl Rock Capital. And so I like to have all three in the mix of my portfolio because the REITs and the BDCs serve the main purpose of basically making money, has higher yields, and uh, helps in times of when the market is low. I'm able to buy more shares and I'm able to solidify my portfolio. And then the dividend growth stocks like Apple, Home Depot, Microsoft, uh, what else? McDonald's. Those typical stocks typically have dividend aristocrats have increased their dividends for 25 plus years. It's going to take time for me to be able to live off that 15, 20, 25 years. So in the right now, in the short term, I let the BDCs, I let the REITs reinvest that dividend within itself so that I can get a bigger piece of the pie so that I can at least have the higher yield right now and then let my lower yield stocks be able to carry on into, when I'm 20, 25 years into the investing category. So just to answer, so stocks versus stock and versus BDCs, I like all three. I have all three in my dividend growth portfolio. But one of the risks that you have to realize is that also when you invest into REITs and when you invest into BDCs, the dividend that you receive from REITs and BDCs are taxed at your regular income compared to uh, stocks, just regular stocks. So stocks like Apple, McDonald's, Home Depot, Lowe's, those dividends are taxed at a qualified dividend once you hold it for, I want to say 90 days. Once you hold that stock for 90 days, that dividend becomes qualified, meaning that it's taxed favorably. 0% to 15%. And then, once you're at a higher tax bracket, then it's like 30%. When you receive the dividend from REITs and BDCs, just know that whatever your income currently right now, whatever tax bracket you're in, that's what you're going to be. That's the taxes you're going to be paying on that income or from those dividends. So just keep that in mind. Yes, BDCs and REITs have higher yields, definitely will help to hit your goal a lot faster in regards to using to pay your bills and to live off the dividend a lot quicker. But at the same time, keep in mind, if you don't have the money to pay for the taxes, then I would say, shy away from putting a lot of money into the REITs, into the BDCs, unless you want to put these stocks into your Roth IRA, which when you put into a Roth IRA, you don't have to pay taxes. Or if you want to put it into a regular traditional IRA, then cool. You don't have to pay taxes right now. Then you're good. But if you buy these BDCs and REITs in a taxable account, yes, you will be receiving high dividends. You will be receiving dividends like $20, $50, $150, $250 at a time. The money is going to be rolled in, and it'll be looking nice. But then at the end of the year, you'll be like, oh wow, I got to pay taxes on that. So if you're not prepared for that, then just keep that in mind. But in my retrospect, I love stocks, BDCs, and REITs all in one because also I'm leveraging all that so I can be able to retire by 50. So hope you guys enjoy this video. Definitely hope you enjoy this video, understanding what a stock, REIT, and what a BDC is. And peace.